Thank you, everyone. Thank you, everyone, for joining this post-spring budget webinar. For those of you who don't know me, my name's Ian Wright. I'm the original founder of Claritas, and I'm going to be joined today by my colleague, Sam Hart, who's a fellow partner and head of our private client team. Yesterday's budget was clearly a pre-election budget. The Chancellor had very little room for manoeuvre from a fiscal perspective and chose to use the room that he did have to make as big a splash as possible in terms of tax cuts. Of course, the tax cuts that we did get come against a backdrop of massively rising taxation because particularly of fiscal drag, whereby people are drawn by inflation and pay rises into ever higher tax bands. Everyone is on mute at the moment, but if you do have any questions, please put them into the Q&A box and we'll answer them at the end. And I'll now hand over to Sam.
Thanks, Ian. So yes, as Ian said, it's very much a pre-election budget, and as has been the trend recently, a lot of the content was leaked. I think the government were burned by the quasi-budget in which hit markets quite severely. So we had heard most of the things that were coming out already, and indeed the national insurance drop had been confirmed by Downing Street in the morning before the budget even started. It was a bit of a rowdy budget. And as we'll see when we get a bit later on, the Chancellor, liked to accuse Labour of copying him all the time and then did an about turn and copied Labour. It is a pre-election budget, and there wasn't actually that much draft legislation that's come out of this. And, a cynic might say that the civil servants don't want to spend time drafting legislation that may never actually make it into law. So a lot of what we're talking about is based on information published by the government after the budget, or in some cases technical notes, but we have very little actual legislation to see what's going to happen. Some of it is going to be subject to consultation, but we'll have to wait and see. Some of the changes are significant, particularly obviously for the non-DOMs, who we'll talk about in a second, but some of them have been more populist, applying to the working population, cutting NI by another 2%, and of course, trying to help with this high income child benefit charge, which I think is a thorn in everybody's side, pending a consultation on how they can assess household income. I mean, obviously, other areas of the government are quite good at assessing household income for benefits purposes, but apparently it's impossible to do that for tax purposes. If you could move on, please, Talia. So some of the main changes at the start were to do with national insurance, as I've mentioned, but I also wanted to mention CGT and IHT, mostly because they were very little mentioned during the budget. There was lots and lots of foreshadowing that IHT was going to be abolished. And normally, if you ask a tax advisor if something is going to happen in tax or what the tax implication of something will be, the answer is always it depends. Anybody who asked me if they were going to scrap IHT, I said not on your Nelly. And sure enough, it hasn't been abolished. Perhaps more surprisingly, I think most people were anticipating a raise in the nil rate band, which has been 325,000 back since 2008. But no, nothing has been done with that. So it's another one of these stealth taxes, as Ian referred to, with all the rates remaining frozen while everything else goes up. There were no massive changes to CGT. No, across the board raising of rates has been feared for some years. And actually a surprise drop in CGT on residential property from 28 to 24%. Mr. Hunt did, of course, quote the Laffer curve, which basically is an economic model that says the most effective tax rate is not necessarily the highest one. I personally don't think that 4% tax is going to have any influence on anybody if they want to sell a property or not, but I remain waiting to be convinced. So if we turn to the NI drop, again, it's quite helpful for workers, and Mr. Hunt claimed that this made the Conservatives the tax-cutting party who were there for the working person. But as has been widely reported in the press, actually the tax burden is the highest for 70 years. So it's a few little cuts around the edges and not actually affecting the vast swathes of people that have been taken into high rate tax. And apparently, over the Conservatives rule, it's the people who earn roughly between 32 and 55,000 who are the winners, and everybody else is in one shape or another one of the losers. So if we move on, Talia, Ian's going to talk about multiple dwelling relief.
So there are a couple of technical changes that were introduced in relation to property. The first is around multiple dwelling relief for stamp duty, and the second is around furnished holiday lettings, which I'll come on to in a second. I'm sure everyone here is familiar with the concept of stamp duty land tax. You buy a house, you pay SDLT at incremental rates that increase as the value of the property you're buying increases, and obviously with a 3% surcharge for those who buy second homes. There is a strange rule that if you buy 6 houses in one transaction, you pay commercial rates of SDLT, which are generally lower than residential rates. But if you buy more than one residential property in a linked transaction, so from the same seller, generally, then SDLT is due on the total consideration, and the band you pay at is determined by the total value of all those properties you're buying, rather than being worked out on each individual property. So you end up with much higher levels of SDLT if you're buying 2 or 3 houses from the same seller than if you're buying one. Multiple dwelling relief was designed to provide a relief from that, so that you would actually pay effectively SDLT on the average price of each property, which generally reduced the amount of tax that people had to pay to what would effectively be a fairer rate of tax. Unfortunately, what was happening was that many people who were buying large houses with outbuildings, with annexes, were claiming multiple dwelling relief, and an industry had grown up around particularly lawyers, property lawyers, approaching people who they could see had bought large houses and trying to make retrospective claims for multiple dwelling relief. And if they were out of time, some of those lawyers were even going further and looking to sue whichever conveyancer had done the original conveyance on the basis that they should have advised people that multiple dwelling relief was available. What has happened is that the first tier court tribunals, tax tribunals, have become clogged with HMRC bringing claims or bringing action against people who've claimed multiple dwelling relief, often on fairly spurious grounds. People were claiming multiple dwelling relief if they bought a house which had a separate granny flat, or if it had a separate garage block. And there were inevitably a lot of spurious claims which have had to be dealt with through the courts. So HMRC have now dealt with that by abolishing multiple dwelling relief for both legitimate claims and the spurious ones. And this will inevitably mean that people who are buying and selling, or particularly buying properties in significant numbers, will end up paying more SDLT. The relief is abolished for transactions from the 1st of June, but it still applies to contracts exchanged by yesterday if the completion is after the 1st of June. And it will inevitably create, as I said, more tax liabilities for people buying more properties. I think the government generally is trying to encourage more home ownership. There is inevitably a move towards more private rental as people find it more difficult to get onto the housing ladder at the bottom end of the market. I think that one of the justifications for this move, in addition to unfreeing the tax courts, would be to disincentivize multiple property purchases by landlords and hopefully therefore free up more properties for purchases by first-time buyers. If we can move on to the next slide, Talia. Now, as someone who lives in Birmingham, the idea of a furnished holiday let in Birmingham is probably fairly unusual. There may not be many of you on this call, particularly if you do live around the big cities, who benefit from furnished holiday lettings, but there are 127,000 houses in the UK which are treated as furnished holiday lettings. And the rules around this have been in place for a long time. They were probably introduced originally to help property owners and to help people who wanted to provide properties for rent by holidaymakers. And if you were able to benefit from furnished holiday lettings, there are a number of benefits. The most significant of which was that rather than paying 28% capital gains tax, as you would if you sold a second house normally, often you'd be able to claim business asset disposal relief and only pay 10% on a sale. You'd also find that there were no restrictions on mortgage interest deductibility in the way that there would be for second homes. And for certain purposes, it would be treated as a trade, all of which brought benefits to landlords and owners of furnished holiday lettings. There were strict rules, as you can see, around how often the properties had to be let and how long a property could be rented for. But the government clearly is trying to discourage this sort of furnished holiday lettings. There has been a growth and explosion over the last few years in properties let through Airbnb and other rental agencies, so much so that it's contributing to major housing shortfalls in large cities, particularly places like Edinburgh, where blocks of flats near the city centre are almost entirely turned over to Airbnb. And so there is a populist move here that by removing the ability for people to benefit from furnished holiday lettings relief, it will encourage some holiday homes back into either the longer term rental market or into private ownership. The new rules will come into effect from the 1st of April 2025. Clearly, HMRC need to work out exactly how they're going to apply, but there will be some anti-forestalling rules to protect HMRC in the meantime. So I now can hand back to Sam, who's going to talk about one of her favourite topics, non-doms.
Yes, and I said earlier that there are winners and losers from the measures announced, and I think most DOMs would consider themselves to be amongst the losing classes. And it was quite a clever move by the Conservatives, really. Reforming the non-DOM regime was always one of Labour's flagship manifesto promises, and essentially they've had the wind taken out of their sails by the Conservatives doing it first while they were still in the power to do so. I mean, it has been a hot topic for some years, and many people have wondered why Rishi Sunak, along with his non-domiciled wife, have not come to the non-dom regime a little bit sooner. Anyway, as I said, we don't have any actual draft legislation on this. We just have a technical note. So I'm going to summarise for you the changes as best I can, but there are likely to be many questions because we don't have all of the detail. But broadly, the idea was to reform the existing regime, and largely it was in the name of simplification, or also to address the unfairness, but in simplification, because the non-dom regime, just by its very name, is based on the concept of domicile, which, as you may know, is an English common law concept that isn't actually defined anywhere in tax legislation, and is therefore subject to case law and interpretation, and even the term remittance. One of my favourite examples, I've genuinely had a client ask me if she buys a handbag in Germany, can she bring that back to the UK? Is that a remittance? So, there is some question over what constitutes a remittance, perhaps slightly less trivial than those questions. But so defining the terms domicile and remittance will essentially go away into the new regime, and it will be far simpler and more streamlined. The new regime is called the Foreign Income and Gains regime, the FIG regime. And the intention is that this regime based on residency will also be extended to IHT, subject to a consultation. I'll talk about that in a second. The Foreign Income and Gains regime applies to those who are resident in the UK for up to 4 years. Now, the definition of resident is going to be in accordance with the statutory residence test, which we've had in the UK since 2013, and actually is, from my perspective, relatively straightforward to apply to situations. It's also important to note, though, that the technical note says that resident will include people who are resident in the UK, but then have a split year period, so they may not be resident for the whole of the tax year, but if under the statutory residency test, they would be considered resident in the UK, that will count for one of your 4 years. And the same for people who are treaty residents. So even if they're not actually taxed as a UK resident because of a treaty, it will still count as one of your 4 years for those 4 years for the FIG regime. And the new FIG regime is relatively simple and straightforward in concept, and it will exempt foreign income and gains from UK taxation regardless of remittance. So actually, for those in the UK in the short term, this could actually end up better for them, that they can spend all of their foreign income and gains in the UK and not be taxed on it. This contrasts to the current system, the remittance basis, where non-domiciled individuals can stay in the UK for a long time and up to 7 years before even starting to pay the remittance basis charge. So it is quite a significant change that it's only 4 years, and as I'll discuss in a minute, this is perhaps why it's going to have such a large effect on the UK's non-dom population if 4 years just isn't quite long enough. So exempted for 4 years, and after 4 years, all foreign income and gains are subject to UK taxation, the same as for other UK residents. Now, you can claim the FIG regime in some of the 4 years, but not all of them. So, for example, if you're a UK resident in year 1 and year 2, but not in year 3, you can still claim it in year 4, even though you didn't claim it in year 3. You don't have to claim for all 4 years. It's a separate claim for each year. But the technical note also refers to up to 4 years after a period of 10 years non-resident. So it does seem to suggest that if, for example, during a 10-year period, you were resident for 2 years, and then you went away for 8 years and then came back for the last 2 years, that those 2 years wouldn't be after a period of 10 years non-residence. But as I say, we don't have a great amount of detail, so that might be one of the things that comes up as the rules get refined. You might be asking the question, what happens to people who were on the remittance basis and then now they're going to be subject to the arising basis on all their foreign income and gains? Now, there are some transitional rules, which I'll talk about in a second, but I think it's also worth noting that the technical note says that after the 4 years, if you were previously on the remittance basis and you have pre-April 2025 unremitted income, and you remit that to the UK, then that will be taxed in the same way as it would have been under the remittance basis. So haven't really got away from the definition of what constitutes a remittance in this example, because we've still got this period where income prior to 2025 could be remitted and taxable on that basis. Just before I get to the transitional rules, I will also just mention the Overseas Workday Relief Scheme, which is basically intended for workers who are not spending all of their work time in the UK. They have referred to changes to that regime, but I think those are intended just to make sure that the regime works as it currently does, but with the new definitions under the FIG regime. So there are some transitional rules. If you're claiming the remittance basis at April 2025, and you've got some pre-April 2025 unremitted income and gains, in 2025-26, you can remit that income to the UK, and 50% of that will be exempt. It is worth mentioning that this only applies to foreign income. It does not apply to foreign gains. So again, there may be some planning that's to be done before April 2025. There is also a transitional relief called the Temporary Repatriation Facility, the TRF, because the government never shies away from a new acronym. And here, where we've got 2025 unremitted income and gains, we can remit those to the UK in 2025, 26 and 2026, 27, and pay a transitional rate of 12%. And again, for some people, this might actually work out quite well for them if they have that income and they can engineer it that they bring it into the UK during those years. The last point on there, Talia, sorry, is that foreign assets in terms of gains can also be rebased. Now, this is for assets held by somebody who was not domiciled nor deemed domiciled in the UK at 5th of April 2025, and the asset is rebased back to 6th of April 2019, which is a completely random date that has absolutely no reference to anything else within this regime. The only grounds I can think is that this is the date where commercial properties are revalued for capital gains tax. It seems a bit random, but you know, who's to say that the government have really thought about this properly? Anyway, so moving on, there are also some quite significant changes for trusts. Now, not everybody might be lucky enough to have a trust or know somebody with one, but there's a certain class of trusts that were protected when the rules changed a few years ago. Provided these trusts weren't tainted, then these trusts benefit from special treatment, even if the settlor or beneficiary was UK resident. Now they're going to lose that protection, and where we've got a UK resident settlor or a transferor, income will be chargeable on an arising basis. Now, from what we understand, this is only going to apply to situations where you've got a settlor interested trust, because often if you've got an offshore trust and there's UK beneficiaries, there'll be a charge to UK income tax anyway. But in this case, we think that's the case. So settlor or the spouse can benefit, or possibly minor children. But again, we don't have a lot of detail, but that's how we think it's going to happen. As I said, there's also a consultation to bring IHT onto the residence basis. IHT is currently governed by domicile. So if you are UK domiciled, you're liable for UK IHT on your worldwide assets. If you're not domiciled in the UK, then you're only liable for IHT on your UK situs assets, which obviously gives some planning opportunities. We do have a concept of deemed domicile already for long-term residents in the UK, which is now 15 years. So that's going to be brought down. The current thinking is that it's going to be a 10-year nose and a 10-year tail. So if you're in the UK for 10 years, you will become chargeable for UK IHT on your worldwide assets, similarly to being UK domiciled. And also when leaving the UK, it will take you 10 years to lose your UK new domicile. And currently, if you're deemed domiciled, you can lose that after 5 years. So it is increasing that period. And as I said, there's going to be a consultation. I can't imagine how much fun that consultation is going to be, because of all of the things that they need to think about and all of the ways in which that affects different other taxes, this definition of domicile, but we'll see how that goes. I did skip over the point there as well, that the current technical note says that non-UK assets settled by a non-domiciled settlor prior to April 2025 will remain excluded property trusts for IHT purposes forever. Currently, if a non-domiciled settles assets from outside the UK before coming to the UK, that will remain an excluded property trust. The government have said that this will apply forever, but as we all know, forever is an impossible concept in politics, and who knows what will happen next week, next month, next year. But at the moment, that does give a narrow window of opportunity for people who are in the position to do something, to think about doing something. And as I said, we don't have draft legislation. It's a little bit like they're telling you rules that are going to come in, and you need to do something if you want to get around it, but also when are those rules going to come in? So one option would be for people who are non-domiciled to maybe just set up a trust now with £10 of offshore money in order to get us trust established, so that they can then put some assets in later once we've got a bit more clarity. Post April 2025, trusts will no longer be protected, as I said, and it will look at the resident status of the settlor at the appropriate time, which will include gifting assets into trust, but also 10-year charges. So again, might be some additional charges on trust, and you just need to look at it and see what you really want to do, and whether, assuming the current rules come in, you're happy with those, or whether you want to take evasive action now to rearrange your affairs and rearrange your trust and other structures to make sure that they fit with what you want to do. There are winners and losers. Winners are people like people who are retiring outside of the UK. You know, it was always traditionally very, very difficult to lose your UK domicile of origin. Now, of course, you can lose it after leaving for 10 years. Similarly, people who only intend to be here for 4 years actually can enjoy all of their foreign income and not pay any tax on it. So those kind of people are winners. Losers are likely to be high value non-doms who might wanted to have been here for a bit longer than 4 years. And 4 years is a relatively short time, and there has been some discussion whether that's too short, and therefore that will restrict non-doms coming into the UK, because they just, you know, it's almost like by the time they've got here, they need to leave again. So I wouldn't be surprised to see a later edition of something akin to the recently introduced Italian scheme, where very high value, ultra high net worth individuals can pay a sum, say 100,000 or 150,000, and that essentially covers them for their UK tax liability on their foreign income. Yeah, so I mean, obviously we haven't got that at the moment, but I wouldn't be surprised to see that come in. And yeah, and then so those are the changes. Not everybody is a non-dom, not everybody knows a non-dom, but it is also still useful to know of the changing landscape and what's going on. But we also thought we'd cover some bits of year-end or other useful tax planning, just so you know, you're all informed and you're all happy and you don't think this was all about non-doms and you don't know any. So just some pre-April action to think about while we're in March. Of course, making pension contributions, the higher annual contribution limit of 60,000 applies. But if you want to use unused contributions from previous years, you can carry up to 40,000 up from the previous years. But the year that will expire on the 5th of April is 2021. But you also have to use the current year's contribution before using the brought forward one. So to maximise, if you haven't been restricted on your contributions because of your level of income, then you possibly need to be paying £100,000 before April if you can possibly manage that. You do need to have earnings, so perhaps that can be managed with employer contributions. The lifetime allowance limit has or will disappear completely from 6th of April. This year has been a little bit awkward in the construction of the legislation, but it will be gone completely from April, although the 25% tax-free amount will then be capped at the previous lifetime allowance limit. There is some discussion whether Labour would just bring it back in again, you know, allowing unlimited heaps of cash into pension contributions doesn't really fit with Labour's ethos. But financial advisor contacts that I know have said that, you know, we've had a few years of restrictions at both ends on contribution and on the overall sum, so perhaps we only need one or the other. So we'll have to wait and see how that happens. EIS VCT claims can be made. You need to be able to claim the EIS in order to get the CGT relief on disposal of EIS shares. So look at whether you can do it in this tax year or the next tax year. You can carry contributions back, but only for one tax year. So just worth looking at that and whether you need to get something in this year or next year in order to take advantage of your income. Also worth mentioning charitable giving, because again, you can carry charitable giving donations back for a year, but you can only do that up to the point at which you submit your tax return. There was a famous tax case some while ago around a charitable contribution of 800,000, and he hadn't put it on his tax return to carry back, so made an amendment, and that was deemed to be invalid. So if you do have a large charitable contribution that you're thinking of giving and want to carry back to get the relief earlier, then, you know, maybe delay submitting your tax return. Although there will be several people who do it on the 6th of April just to be a bit smug and show off. Obviously take advantage of your ISA allowances, and the Chancellor did announce yesterday a new British ISA, although we have very little detail on that other than that it will be £5,000 and it will be in addition to other ISA allowances. We also advise people to look at using CGT annual exemptions, but you know, the value of that has been drastically reduced. So it's currently 6,000 going down to 3,000 from 6th of April, but still possibly worth doing. I mean, my personal opinion is that that might go back up again shortly, only because the administrative burden for the HMRC of processing people who need to pay capital gains tax and a gain of £4,000 is probably a little bit excessive. But it's also worth looking at claiming losses for CGT and making claims, things like negligible value claims. Again, you can use those in a previous year, but you need to make sure you can claim them at the right time so that you can use them in the right time, because otherwise you can't claim capital losses back. You can only claim them forwards. So it's worth looking at, the right time for making those claims. And some of the time limits, if you have made a holdover claim, for example, you've got 4 years to do that. So don't miss out on the time limit. And the same with overpayment relief. If there's an error on your tax return, you can only go back for 4 years. So make sure that you do it before the 5th of April so that you don't lose out. And the last thing that we were going to talk about, Ian is actually going to talk about family investment companies, so I will skip over those bits. But I just thought I'd mention some other tax planning things that we see a lot with our clients. Trusts, I mean, I love trusts. They can be a more useful alternative to family investment companies, though I'm sure Ian will disagree. But they are, something to be used as part of a planning remit that you have. And although I've talked a lot about, non-DOMs making trusts before the changes come in, you don't have to be non-UK domiciled to benefit from a trust. There are many ways in which a trust can be beneficial for you and your family, particularly in terms of IHT, which is not going away. And it's important to think about, how you want to use that trust. What's the purpose of it? Can we put some structures within the trust to, make sure the tax is optimized for what you're trying to achieve? And the bottom bit there is about maximising BPR. Again, we hear lots of chatter every budget about changes to BPR. Are we going to lose, this, or are they going to amend it for AIM shares? At the moment, BPR is still there, broadly as it's been for many, many years. But there are still things you can do to maximise your BPR. You can do things with will planning to make sure you get that BPR as many times as possible. You can invest in BPR investments such as AIM portfolios or other unquoted companies. And finally, some trades do qualify for BPR, even if you might, on the face of it, think there might be investments. Property development is a good example. But, we can advise on some of the other things that you might be able to do with a company that allow you to achieve what you're trying to achieve more broadly, but actually get you some of that valuable BPR.
Well, thank you, Sam. At Claritas, our core market, as I'm sure most of you are aware, is business owners and their businesses. We do have a few listed clients, but the core of what we do is really around entrepreneurial owned businesses. And it is fair to say that over the last few years, the entrepreneurs of Great Britain have taken a massive hit from the government. If you look back to 2015, 2016, we had a situation where companies were paying corporation tax generally at a rate of around 20%, and dividends were taxed at around 25% for high rate taxpayers, 13.5% for additional rate taxpayers. For those individuals at that point, for the people who owned shares in companies, paid corporation tax on their profits and then extracted dividends, they were keeping around 56 to 60% of their pre-tax profits by the time it got into their own hands. If you look at the situation now, with corporation tax at 25% and dividends being taxed at up to 39.35%, the entrepreneur is retaining somewhere around 45% of what they receive, of what they generate within the company. So there's 11% less than they were receiving a few years ago. And that has had a massive impact on the way people look at things. We're seeing more and more clients looking at how they can manage their profits and the extraction of the profits in a tax efficient way. And one of the great things we've seen and great innovations over the last few years has been the family investment company. If you are a business owner or advising a business owner who needs to extract every single penny they make from the business in order to pay for their shopping and their mortgage, then this probably isn't relevant. Unfortunately, those people will have a simple choice. Do they take dividends or do they take salary? And there may actually be an argument now for looking at that again, particularly with the national insurance savings that were announced yesterday. But if you look at the people who are generating more profit than they need to spend, than they need to live on, who are investing their profits maybe in assets outside of the business, so looking at second homes, looking at property portfolios, looking at investing in other businesses that aren't related necessarily to their main trading organizations, then family investment companies can be a great idea. And the idea of a family investment company is that it can become a shareholder alongside the founder, alongside the entrepreneurs in the trading company. UK companies don't generally pay tax on dividends they receive from other companies. So a family investment company as a shareholder in a trading company can receive dividends that have only been taxed once. They'll suffer the 25% corporation tax within the trading company. But if the dividend is then paid to a family investment company, no further tax arises. So an entrepreneur can set up a family investment company. It becomes a shareholder alongside the entrepreneur and alongside any management teams in the trading company. It receives a dividend and it will receive effectively 75% of the profit that's generated, the pre-tax profit that's generated within the trading company. It can then invest those profits in whatever it wants. It can invest them in properties that may be used in the trading company's trade. It can invest them in other commercial properties. It can be used to invest in residential properties, or it can be used to invest in stocks and shares, or whatever else the entrepreneur decides they would like to invest in. The beauty of this structure is we can put it into place with only minimal tax cost. There will be stamp duty, but there shouldn't be any capital gains tax, and the stamp duty will be at 0.5% on a value that will relate to the future tax. The future value of dividends to be received. So it's a very tax efficient structure to put in place, and it allows individuals to really manage their investments, manage the assets that are generated and the profits that are generated by the trading company. A lot of people who generate substantial profits within trading companies are very aware that if anything happens to the trade, if it fails, then all of their wealth is tied up within that trade and would also be at risk. Whereas if it can be extracted tax efficiently, it can be protected. And we've used this structure for clients who've been able to protect the assets that have generated by the trading company. And because those assets have been protected, they've been able to take a different view of risk within the trading company, and have been able to take more risk within trading companies, knowing that their downside had been protected. And that has allowed them to grow their trading companies more quickly, generate more wealth, generate more tax, dare I say it, for the exchequer. And so this is probably one of the most attractive tax planning techniques that we've developed over the last few years. Once cash is within the family investment company, it can then be reinvested. The family investment company will pay tax at the corporation tax rate of 25%, but that compares with a situation where the poor entrepreneur has extracted the cash, is only able to reinvest 45% of whatever's been generated within the trade, and now suffers another 45% on the profits that are generated from that investment. Within the family investment company, they can reinvest 75% and will only suffer 25% tax on the profits that are generated. So it is a really beneficial way of managing wealth, managing the profits that are generated from within trading companies. We're also increasingly seeing entrepreneurs who've generated sufficient wealth within their trading companies to know that they have more than enough to support them through the rest of their lives. Why pay even capital gains tax at rates of up to 20% if you're never going to spend that money? If you structure the family investment company as a shareholder in the correct way in a trading company, if it has more than 10% of the shares, more than 10% of the capital rights within a company, within the trading company, then it can potentially sell its shares in the trading company tax-free, benefiting from the substantial shareholdings exemption. So the founder of the business can take the cash that they need for the rest of their lives from a direct sale of the trading company, with anything else being received by the family investment company for reinvestment in a tax-free way. And we're seeing that becoming more and more attractive to entrepreneurs ever since really the entrepreneurs relief rate was, or limit was reduced from £10 million to £1 million. And I think if we find a situation where under a new government that limit is reduced further, then this is likely to become even more attractive. So yes, we are seeing an environment where tax is increasing, tax rates are increasing, partly through fiscal drag, partly because of deliberate measures to increase tax rates. But there are still things that people can do. We wouldn't do this without HMRC clearance. So it's something that's a well-trodden path. It's something that we can do. If you're an accountant, it's something we can do for your clients. If you're a client, it's certainly something we can look at for you as a way of really managing your overall tax exposure as time goes on. I think that then brings us to an end, Talia, does it not? So if anyone has any questions, I don't know, Talia, if there's anything you can read out from the Q&A box.
Nothing has come through at the moment. But obviously, if you think about anything and there is something that you want to ask, please do email us and we'll be more than happy to answer.
Either that or we've just answered all your questions before you've asked them.
Well, in that case, rather than prolonging things, I'll let everyone get on with their day and just talk about our next webinar, which is on innovation tax relief. So primarily R&D tax relief and the patent box. I think a lot of people will be familiar with R&D tax relief, but there are significant changes coming to that regime, partly because there have been a lot of rogue claims, but the relief is very much alive and kicking. We're making a lot of claims successfully for clients who are undertaking genuine R&D. And I think Caroline will also be talking about the patent box regime. For those of you who aren't familiar with the patent box, that allows companies that have patents and are exploiting those patents to pay corporation tax at a rate as low as 10% on some, probably not all of their profits, but certainly on some of their profits. So if that is something that you are doing, if you are exploiting patents, if you are developing intellectual property, whether it qualifies for R&D, for patent box or not, then that should be a great webinar on the 26th of March. So please sign up when you can. Thank you very much.